Guys and girls, it's Daniel Walsh from Your Property Wealth, and today I'm here to talk to you all about interest rates. Now, in the media right now, they're talking about interest rate hikes and how interest rates could rise over the next year, and how Commonwealth Bank are coming out saying that interest rates now could rise earlier. And they're starting to, scare people, yet the RBA is saying that they will not raise interest rates until 2024. What I want to do is break all of this down for you so that you have a better understanding on what's going on with the economy, what's going on with interest rates, and how they can't go up long term, and that they are going to have to stay low for relatively a long time. And I want to talk to you about that today. So number one is, why would interest rates rise? Now, there's two reasons why interest rates are going to rise. Number one would be to slow the market, and number two would be to fight inflation. Now, what I want to do is talk about the two reasons why they could increase. Now, the number one reason that the media is talking about, and remember, this is the banks that were talking about a 30% drop when COVID hit in terms of house prices, and yet we never saw any of that. We saw the exact opposite, where house prices probably rose 30% rather than dropped 30%. So anything they do say, I take it with a grain of salt. Now, if we want to look at slowing the market and how they're looking at it, they're saying we want the housing market to slow, and we're going to have to put interest rates up. And that's what everyone's thinking. Interest rates will go up to slow the market. The problem is this. We've got two things that we're trying to, look at. We're looking at the economy, which is one, and we're looking at interest rates, which is the other, right? And that's the housing market. So when we're looking at it, we go, okay, if we're trying to stop the housing market from growing too much and becoming too unaffordable, if we put interest rates up, then what's going to happen is it's going to slow the economy. So for us to slow the housing market down, we have to hurt the economy, which is what we've been trying to kickstart for the last 12 months with all this stimulus, and the continuous of this stimulus, we're trying to kickstart the economy. So there's no sense upping the interest rates to make people feel poorer so that they don't go out there and spend money, so that the economy then slows down further and we hit recession. Now, we're trying to get ourselves out of recession. We're not trying to put ourselves into the recession. Now, if we were going to put up interest rates to slow the market, that's not going to be good for the economy. The best thing that they could do is increase serviceability. So if you want to just hit the market, you want to just hit the property market, and you want to slow it off and make sure it doesn't grow too much, then what you would do is you would increase serviceability calculators so that no longer can you borrow as much money. If you can't borrow as much money, you're not going to go to that same market and buy for a higher price, are you? So if you want to slow the housing market, you can do that individually without hitting the economy. You can do that via serviceability calculators. And I believe that the serviceability calculators could become a little bit tougher over the next year, so that they try to slow down the housing market. Now, the other thing is to fight inflation. So we're thinking, okay, as inflation starts to grow and we start to see high inflation, they then have something they've got to go, okay, do we fight the inflation by increasing the interest rates, or do we let the inflation grow and continue to devalue our dollar and devalue the debt at the same time? Now, the reason why they won't put interest rates up because of inflation long term is because it'll hurt the economy once again. And if we hurt the economy, we're going to be, what do you want to do? Hurt the economy, raise unemployment rates, make sure we have to then have more stimulus, which is then going to turn into more inflation down the track. And/or do we let the inflation run wild now, and hopefully that runs out of steam after a while, so that we can have a bit of equilibrium in the future? So they're the two reasons why interest rates would rise. We already know that to slow the market, you can do it by increasing serviceability, and they won't increase interest rates to slow the market because it will hurt the economy. Now, when we slow the economy, unemployment rates would rise. So if we're going to raise interest rates and we have the unemployment rise, and how this all works, and I had a few people ask me, how does unemployment rate rise if interest rates rise? Because what happens is, if you don't want to go build a new house, then that builder is going to slow down. Then that means all the tradesmen are going to slow down. That means that those tradesmen may not go to a restaurant. So that means the restaurant slows down. All of a sudden you see a knock-on effect throughout the economy in every industry because the interest rates have risen, and what's it actually doing is it's scaring people into hoarding money, into saving their savings and putting it away for a rainy day. Now, if we save money, we slow the velocity of money, and all of a sudden the economy starts to slow. And it doesn't matter how much stimulus we put into the economy, if we all don't feel confident in the economy and we save money and the velocity of money slows, they can print money endlessly, and we're not going to see GDP growth and economy expansion because we're all just saving the money that they're giving us. Now, I want to talk about stimulus. So when COVID happened, we saw stimulus. Now, the stimulus, the way that I look at stimulus is it's like a fire, right? So last year they had this fire, the fire was going out, and they've just chucked all this wood on the fire. They're making the fire blow back up again. Now, when you're trying to get a fire started, there's no sense of just chucking water on it straight after you get the fire going. They've got the fire now going. They've started to stoke it. We're starting to see the economy move. We're starting to sort of walk out of recession for the short term, not the long term. But what they're doing is they're dropping the unemployment rate, and the economy is starting to move. Now, when we're talking about interest rates rising as well, people are talking about it and saying, well, interest rates are going to rise. They have to rise. They have to slow down the housing market. Well, let's have a look at the last 10 years. When we came out of the last recession, what happened? We saw interest rates continually drop, even though the housing market was out of control for a decade in Sydney and Melbourne. So we saw housing prices double in value over that period of time, and yet they didn't come to rescue anyone by raising interest rates because they had another problem on their hands, and that's called the economy. And the economy was slowing down. They couldn't fight the housing market going up in value. So what they had to do was focus on the economy rather than the housing market. It's the exact same thing now. We're trying to avoid recession. They're going to be focusing on the economy. They're going to be focusing on unemployment rate. They're going to be focusing on inflation. They're going to be focusing on wage growth. They're trying to get the economy moving, and they're less likely to focus on the housing market to save the middle class. And that is the thing. They will talk about saving the middle class, because if they don't talk about saving the middle class, well, then everyone's going to be in uproar thinking, well, no one's helping us, the government's not helping us. So what they do is they then bring new stimulus packages for the middle class so that they can get into the market, continue the price rises in the housing market, and that's actually going to hurt us long term even more. That's actually going to make house prices rise even more. Now, I want to talk about interest rates and how they can't rise long term. Now, interest rates can't rise long term. Number one is debts are rising. So we aren't seeing wages rise, but we are seeing debts rise. Now, as debts rise, the government's debt is rising as well, because we continue to put more stimulus into the country so that we can prop the economy up. Now, if the government's basically taking on more debts, then what we're seeing inflation. We're seeing more inflation happen throughout the economy. We're seeing the government take on more debt. And the more debt they take on, the less likely that they can pay that debt back at a higher interest rate. So interest rates have to stay low long term, because if they don't stay long term, then we are printing money that we can never pay back. Now, how do we get rid of that money, the debt? How does the government get rid of it? They get rid of it by inflation. So when we see high inflation, what happens is the debt of the government is devaluing over time. So you don't pay back the debt, you devalue the debt. If you devalue the debt, you don't have to pay back the debt. And that's what the government's doing now. They're silently robbing the middle class of their savings, because their saving is devaluing every single year. If you have a look at it from last year, right now, if you were to buy a property today, if you had $100,000, let's say, and you wanted to buy a property last year, you would have bought a better property than you would this year with that same $100,000. And that is inflation, because the government are printing money and stimulating and putting all that money into the economy, expanding the monetary system, expanding the money supply. And if we expand the money supply, the inflation happens, but it devalues debts. So that's actually good for housing, because for housing, if you take on a debt, and you take on a house, all of a sudden the house price is rising, but your debt is staying the same. It's actually devaluing because the dollar is devaluing. It's not like the houses are getting any better. It's just that there's more dollars to pay for the same house, and the dollar is devaluing against the asset or the hard asset, which is the house. Number 2 is GDP. Now, they're going to focus really hard on the economy, basically what's happening with the economy. The economy right now in terms of GDP is false because it's stimulus that is pumping up the numbers of GDP. It's not real productivity. We're not seeing people go out there working hard, and we're seeing the real productivity of our labor grow, and all of a sudden our economic expansion is because of productivity. But what we're actually seeing is the stimulus is making the economy grow. We're growing on a false economy. And if we grow on a false economy, that's got to end at some point. And if that ends at some point, then interest rates have to drop again because the real economy isn't actually expanding. It's a false economy that is expanding. Number 3 is people start hoarding money. If we see interest rates rise and they rise a few percent, then what we would see is people just save their money. They would go back into hoarding. Velocity of money would then start to slow down. The economy would start to slow down. What we've got to look at is when we're looking at this whole scenario of interest rates and the economy, we've got to look at it from the government's perspective. Now, when you look at it from the government's perspective, they are running a business. They are running a business, which is the country. Now, what they've got to do is they've got to bring revenues in, and they've got to cash flow the country. How do they do that? From the people. The people have to go out there and work. When they work and work and work, they pay all their taxes. The taxes goes to the government, and the government can pay back the debts that they've been taking on to be able to prop the economy that's been a false economy for quite a few years. Now, what happens though is if we put up interest rates and we see unemployment rates rise, we're going to see the government go, well, our cash flows have dropped. We now actually got more liabilities, which is the people, because unemployment rates are rising again, and we're seeing the economy slow, and then they're going to have to do another bout of stimulus. It's like, why would they want to go through all of that again? They're going to try and get themselves out of that so that they don't have to keep spending money in terms of getting more debt, taking on more debt, putting more stimulus packages out there. Their goal is to get the unemployment rate down. Their goal is to get their business up and running again. And they're not going to stop that to try and help you with the housing prices. Number 4 is the dollar. Now, when we see the dollar, if the dollar is dropping, when we say the lower dollar, we want to stay competitive. So a lower dollar means we're more competitive with exports. Now, if we're more competitive with exports, which if we look at it right now, exports, iron ore, we're looking at real estate and building industry, and we're also probably looking more at like tourism and that, which is going to be our growth for the economy. However, if interest rates rise, the dollar would increase. And if the dollar increases, we're no longer competitive with the rest of the world for exports. We want to be competitive. How do we be competitive? If we keep interest rates lower, we can have a lower dollar, we stay competitive, and people are going to want our commodities, and they're going to want us to export to them because it's cheaper. So if we can do that, then that's what we're going to do. So another thing is the dollar, is keeping an eye on the dollar. As the dollar gets higher, that's actually not going to be too good for us for exports. Number 5 is wages haven't grown, yet people have taken more debt on. So as interest rates have decreased over the years, we've taken more debt on. And a lot of people say, well, that's why the housing market's going to crash. This is like a Ponzi scheme at the end of the day. The way that the economy is at the moment is we're in a recession. Essentially, we're in a recession and we're trying to get ourselves out. Now, as the economy gets worse, that means more stimulus will come in, and that's actually good for asset prices. So as the economy gets worse, it's better for asset prices because they are going to throw everything they can at the economy to be able to make sure that they don't go into recession. So as much as we say, okay, wages haven't risen and debts have increased, They also know that interest rates can't increase that much either, because if they do, they're going to have people go into foreclosure, and that's what people think. Oh, well, people just go into foreclosure and it is what it is. Well, if that's the case, then when COVID hit, why weren't they just letting everyone go under? Why didn't they just let everyone go under then? Why did they have to print all that money? Why did they want to print all that money? So they're not going to let that happen. And because we've already seen it when COVID hit, that they didn't do that, they didn't let house prices drop, they didn't let unemployment rates go up too high, they stimulated the country and they did what was necessary to print the money, put it into the economy, even at the detriment of the house prices growing out of reach for many people. The government, the RBA, especially the RBA is not here to control house prices. The RBA is here to look at inflation. They're here to look at unemployment rates and the economy. Now, they're not here to save you. As much as they say they are, they're not here to save you. Interest rates cannot rise long term. This is why they can't rise long term. Now, I want to talk about why we should be buying houses now. I talked about this during COVID when it happened, and a lot of people actually were putting comments in there saying you shouldn't be saying you should be buying houses now and all of this. This was mid-COVID, and at the time I was saying that there's a housing boom was going to happen because the economy was in such bad shape that they had to print their way out of it, which was going to mean that all asset prices would rise because all of that money would flow into assets. Now, number one thing is why are we buying houses? Because it's inflationary, right? If we're in an inflationary period over the next decade, because we're trying to really, this is not even Australia, this is globally, really we're trying to get out of what we are globally. All developed countries are starting to fall into negative interest rates, and why we're doing that is because the economy is going down the tubes. Now, we're going to print more money beyond measure over the next 10 years, and it's going to be a wave of up and down. That wave of up and down is going to look like this. It's going to be inflationary, then deflationary, then inflationary. What we're going to see is we're going to see inflation, which is what we're seeing now in the asset prices. Then we'll see probably a taper off, and we might even see deflationary. We might even see headlines of things going bad and the economy is getting worse again. And then all of a sudden, that will turn into deflationary. People start saving money as they get scared. And all of a sudden, they're going to hit it with stimulus again. And we're going to see another inflation period. We're going to see the ups and downs of this probably over the next 5 to 10 years, trying to get out of it. But over the long term, the inflation is going to help assets, but it's also going to help you from losing value from your savings. If you just put your money in the bank, your savings is just going to keep devaluing every single year. If you have a look at what you could buy in the housing market 5 years ago to now, it's going to be a lot less. Your dollar is going to go a lot less further than it did, 5 years ago. So that is one thing, is why we're buying houses now. Number two is, I believe that instead of interest rate hikes, I believe serviceability calculators will get harder to try and slow the housing market down. However, long term, inflation will make houses grow. And again, houses will grow. It's like when you go to McDonald's and the cheeseburger, right? The cheeseburger's gotten smaller over the years. However, it's gone up in terms of how much it costs to buy a cheeseburger. Why has that happened? The cheeseburger didn't get any better. What happened was we've seen the dollar devalue over time, and that's made the cheeseburger worth more over time, even though it's gotten smaller and probably not as good. So serviceability will become harder. When we see serviceability become harder, it means that you can't then jump into the market. We saw this a few years ago where we saw they wanted to try and curve the price growth in Sydney. They saw that prices in Sydney were starting to get out of control. What did they do? They didn't raise interest rates. They increased the serviceability calculators. So if they increase the serviceability calculators, what they're going to do is try and slow the market down that way. But what happens is you should be trying to buy as much property when you can, because if they do increase the serviceability calculators and you can't get into the property market, well, then all of a sudden you're going to have troubles, because when we see this period here, if you can't get into the market, you can't save yourself from the long-term inflation that's happening with the economy, because they're trying to get us out of recession. So as serviceability calculators get harder, we're going to see probably serviceability calculators get harder. And then if we see the market taper off and we see any slow in the economy, it'll get easier again and we'll be riding that wave. Now, when serviceability calculators got harder a few years ago, if you had bought just before that serviceability calculators, when they did get harder, if you had bought, you would have benefited now because the property prices had increased. But there were a lot of people that couldn't get into the housing market because the serviceability calculators had increased. So your job is to try and get into the housing market to be able to have a safe portfolio, but build a safe portfolio, but do it when you can, because we don't know when these calculators are going to continually get harder and harder and harder, and how long they're going to get harder for. So I think that the serviceability calculators will get harder. Interest rates may go up temporarily. We saw this in America a few years ago, and they didn't last very long with interest rate hikes. They talked about interest rate hikes, they did a couple of interest rate hikes, and then all of a sudden they fell straight back to zero. It's a false economy that they're running off right now. It's stimulus that they're running off right now. Yes, we are in terms of slowly trying to get ourselves out of this recession. However, we've got a long way to go before we are continually, or we're out of the recession totally. And I believe that as the economy continues to get worse and deepens and the dollar devalues, that's going to continue for the asset prices to rise long term. Anyway, guys, if you like my videos, please like, share, and comment. And until next time, guys, have a great day.